So without further ado, I want to express our thanks to our great partners at ICR Capital for partnering with us on today's program and lending their time and their insights and joining us today. So I'm going to ask Raj to introduce himself first, of course, and then introduce his colleagues before they take it away and walk us through some of the topics. So Raj.
Thank you so much, Anna. Before we start, I wanted to spend a minute on who we are and what we do. ICR is a leading independent capital markets advisor, as well as an investor relations firm. And within ICR, our team helps clients with convertible equity derivatives and other similar transactions. If you're considering a convertible offering, there are hundreds of nuances to think through. You want to make a data-driven decision, but most of the data are not publicly available. And most importantly, you're probably extremely busy. Now imagine if you could hire a team of ex-investment bankers to work with you and for you with a singular mission to give you honest advice and help you get a great deal done easily and efficiently. That's our team. We're a bit unique compared to other advisors because in addition to our convertible expertise, we have colleagues who are specialists in equity, SPACs, warrants, investor relations, etc. This gives us extraordinary market and industry insight and allows us to give you advice that is both holistic and incredibly focused. Today, you'll hear from my colleagues Anna Shearer, who spent more than 14 years at Sherman & Sterling, Barclays, and Wells Fargo covering capital markets and equity derivatives, and Niren Nazareth, who runs our SPAC business and has 20 plus years of capital markets experience, most recently on the convertible and SPAC trading desk at Deutsche Bank. I'm Raj Imteaz, and I have 17 years of convert and equity derivatives experience, 15 of which I spent at Barclays and before that at Lehman Brothers. We'll start our conversation with SPAC redemption dynamics and impact on the cap table. We'll talk about warrant considerations and equity market alternatives. We'll then move to the convertible market and discuss a few nuances that are pertinent for SPACs. And then lastly, we'll cover securities law considerations for SPACs. We have a lot to cover, so let's get started. Niren, do you want to take it from here?
Yes, thank you, Raj. Just a quick note before I jump in. I'm going to use the term SPAC to describe companies in the SPAC marketing process or transaction process that starts with the merger announcement and ends with the shareholder vote. I'm going to use the term deSPAC to describe companies that have closed their SPAC business combination. And hopefully I keep it consistent. So to get started, SPACs that have closed their business combinations in 2022 have faced relatively high redemption rates. High redemption rates are negative for many reasons, but I'll focus on two of them here. First, redemptions directly remove cash from the balance sheet, from the cash and trust, and then the balance sheet of the pro forma deSPAC company. And then since the IPO shares that are redeemed constitute the majority of shares after the business combination, the shares in the float and the turnover, removing shares from that pool has a negative effect on the company's ability to access capital. This pattern of high redemption rates is a relatively new phenomenon, and we'll explore some of the underlying drivers as well as how companies are approaching the problem. Next page, please. So let's first frame the problem of SPAC redemptions. If I can draw your attention to the graph on the bottom left of the page, that blue line, you can see that in the first quarter of 2021, redemptions were around 11%. And in the first quarter of 2022, redemptions are 85%. This is due to a few factors, including poor trading performance of deSPAC equities, which have made investors reduce their risk tolerance. 67% of equities, SPAC equities, are trading at a discount to cash and trust, and a heavy influence of arbitrage investors or hedge funds. Often we hear management teams say that or blame hedge funds for high redemption rates, and this is partially true. If we look on the right-hand side, that's the top 20 investors, and you can see they're all hedge funds. 90% of the top 50 investors are hedge funds, arbitrage investors. And they control 60% of SPAC equities. But fundamental investors also redeem. And if the stock is below, if the SPAC equity is trading at a discount to cash and trust, they will redeem, even sometimes if they own a position in the PIPE. Next slide, please. As redemption rates increase through 2021, the SPAC market is trying to explain some of the underlying drivers. For example, we've heard that bigger transactions have lower redemption rates. And if you look at the graph on the lower left, the x-axis is enterprise value and the y-axis is the redemption rates. And you can see there really isn't a strong relationship between the size of the deal and the redemption number. We've heard similar things for industry or sector, perhaps the underwriter. You know, in our analysis and estimate, the real material driver of and predictor of redemption rates is price. And if you can look with me at the bottom right-hand graph, you'll see the scatter plot lines up real nice, right above $10 or a little bit more than $10. And if you take your eye to the x-axis right before 1050, just at that price at 1050, redemption rates essentially drop to zero. There are ways for SPACs to address the symptoms of redemptions by engaging in trading strategies or structures that incentivize SPAC holders not to redeem. And maybe now I can hand it over to Brian to talk about legal structures that are used to minimize and reverse redemptions.
Thanks, Niren. Yes, due to this trend that Niren covered in increasing shareholder redemptions, de-SPAC parties are very laser focused on ways to minimize and reverse redemption decisions. So from a legal perspective, parties have several options at their disposal. To start, a SPAC sponsor or its affiliates may consider offering a portion of their shares or warrants to the SPAC's existing shareholders in order to obtain a commitment from them to not exercise their redemption right. Alternatively, the SPAC sponsor could offer a cash payment in exchange for a non-redemption guarantee. The offer could be structured in many different ways. There's a lot of flexibility here. It can be made limited to holders that have a certain amount of shares, so at least a X number of shares, or it could be given to holders that accept by a certain date, or on a first come first served basis, or up to a specified amount if there is as there often is, a specified minimum cash requirement or condition in the BCA. This option is helpful in advance of a redemption decision, but there's still an option post-redemption decision as well if the sponsor is able to target a few shareholders that have already exercised their redemption in order to try to get them to redeem. This option has benefits and drawbacks. Some of the drawbacks, obviously, is that it's difficult from a timing perspective to implement. The redemption decision has already happened. So there's a very limited period of time in order to approach these redeeming shareholders to try to offer them the cash payment that would have them reverse. The benefit is that one does know who the redeeming shareholders are and can target the number of redemption reversals that's necessary in order to hit whatever mark, whatever conditionality is in the BCA or otherwise, in order to move forward. More targeted offer can be made. So that's the benefit there. Next slide. The SPAC, due to its structure and due to the cash being limited to the SPAC's trust account, the SPAC is unable to issue additional securities that would vote on the business combination and thereby negating some of the redeeming shareholders. So that is not an option the cash payment, if one is to be made, would need to come from the sponsor of the SPAC or one of its affiliates. Another option that we've seen to mitigate shareholder redemptions are backstop agreements. We've seen the SPAC sponsor its affiliates or even unaffiliated financial intermediaries provide a backstop agreement to address a high number of shareholder redemptions. The financial backstop is often structured with flexibility to allow the financial intermediary to go into the market and to purchase on the open market or in private transactions shares that the backstop provider would essentially be, reversing that redemption provision, and they would be buying those shares at a price that is below below what the combined company is doing its deSPAC at. So there can be a benefit there. And obviously, lastly, before I hand it back to Niren, a less desirable outcome for addressing shareholder redemptions is for the target company shareholders to reduce their cash consideration that is going into the combined company in an amount that equals the shortfall resulting from the shareholder redemptions. Obviously, the ownership percentage of the target shareholders would go up as a consequence, but it would address a high number of shareholder redemptions. So I'll hand it back over to Niren to continue on with the impact of shareholder redemptions.
Sure, thanks, Brian. So what impact do redemptions actually have on the pro forma business? In the bottom left graph, we have redemption rates for companies that closed their transaction in the first quarter of 2022. And now the axis here is sort of the inverse of what we've been talking about. This is the percentage of SPAC IPO proceeds that were retained by the SPAC, or 1 minus the redemption amount. We did it this way so you could see how much white space there is. If I can draw your eyes to the 20% mark here, this gray line, you can see that 80% of the companies on this list had more than 80% redemptions, or said another way, 80% of the companies on this list retained less than 20% of the cash in the trust. Obviously, we talked about some of the negatives here, but one of the impacts they have, we'll talk about the capital raising implication. As you know, the warrants stay outstanding even after the SPAC share is redeemed. And so if you take, for example, a SPAC that had 100 shares and 100 warrants, if it has a 90% redemption rate, the ratio is no longer 1 warrant to 1 share, it's 10 warrants to 1 share. And if you look down the right-hand side of those bars, you can see the implied warrant ratio, or sometimes referred to as a warrant overhang. Addressing higher redemption rates leave these companies with higher effective warrant coverage ratios, which sort of adds complexity to the cap table. While addressing the warrant overhang doesn't necessarily raise cash for the company, it's more likely to be a mitigation or liability management exercise. It can improve the float and reduce frictions to raising capital. So let's move to the graph on the right-hand side. The point of this graph is that high redemption rates affect de-SPAC companies in that they can raise less capital as a percentage of their market capitalization than the normal public companies can. Normally, a mature public company can raise about 20% of their market capitalization in a follow-on offering. But if you look down the list on the left-hand side, you can see you have to go halfway down to find a company that's even at 3%. So for a de-SPAC company with $1 billion market cap, it can raise $30 million gross. This is another sort of impediment that these companies face after experiencing high redemptions. Next page, please. Sometimes we hear management teams say that share liquidity just naturally increases over time. And so for a public company, they just have to wait out the problem. we analyzed the 17 SPAC mergers that closed since August of 2021, which gives them enough trading history for us to see 50 or so trading days. We looked at the ones that had 80% redemptions or more and had raised an equity pipe, because we would hope and expect that an equity pipe would contribute to the float and contribute to share turnover over time. So if you look at the graph in the bottom, of the 17 companies, only 2 of them had more liquidity 50 days out. For the rest of them, they had at least 27% less liquidity, and the average was 68% less share turnover. We're going to follow this cohort over time, so if you're interested in an update, please get in touch. Next page, please.
Thanks, Niren. Continuing on the liquidity, covering here legal considerations related to liquidity. The deSPAC parties ought to ensure that the company, after the deSPAC, will have adequate equity research coverage by a reputable investment bank following the transaction. This is typically less of a concern in the IPO context. If an issuer is doing an IPO, as that issuer already has a syndicate of investment banks acting as underwriters at its disposal that are laser focused and have done diligence and done the work understanding the issuer and its securities, and so there's research coverage naturally as part of that process. It's different, right, for a deSPAC that doesn't have those IPO underwriters at its disposal and that experience. But nonetheless, the newly deSPAC company will need to ensure similar coverage in order to maintain a liquid trading market that's analogous to what it would be if it had done an IPO. Additional legal hurdles here to liquidity results from the former SPAC's status as an ineligible issuer. Anna Pinedo later will get into the nuances of that definition, but for our purposes, it results in the former SPAC not being able to use many of the communication safe harbors under the Securities Act, as we note on this slide, that operating companies that don't have the former SPAC ineligible issuer status are able to take advantage of. As a result, these restrictions on research and communication, it negatively impacts liquidity, trading activity of the deSPAC company. So rules 137, 138, 139 here, these all relate to different varieties of research reports, either about the issuer and its securities or about the industry in general, whether the author of the research report is an active participant or not in a issuer's offering. But these are safe harbors that are routinely relied on in order to provide information to the market about securities. Ineligible issuers are also unable to rely on the free writing prospectus rules. So the practical consequence impacts roadshow presentations. They're subject to additional restrictions under Securities Act Rule 433. Any roadshow that is a written communication is considered a free writing prospectus. And so the way that not having an ability as former SPACs to rely on that, their roadshow presentations need to be done in a real-time live fashion in order to not be considered a written communication and trip those rules. So just, additional legal hurdles that need to be overcome, and if they're not navigated appropriately, potentially have a negative liquidity impact here. These restrictions, as noted on the slide here, do expire after 3 years post business combination. And it's worth noting there are other rules, communication rules that the former SPAC can rely on. It can rely on Rule 134. This is the rule that issuers typically rely on to issue, launch, and press releases related, pricing press releases relating to securities offerings. So that type of normal course can happen, which is very important. Access equals delivery is another area that former SPACs can rely on. They can also rely on the testing the water accommodations that emerging growth companies rely on. So there is some good news there too. Next slide. Many SPAC shareholders, including all of the insiders, signed lockup agreements restricting their ability to sell or transfer securities after the consummation of the business combination. This typically lasts for a 180-day or even a year long period, and so that impacts the liquidity of the de-SPAC securities after the transaction. Obviously, a significant number of locked up shareholders will reduce the possibility of a significant number of sales occurring immediately following the merger. PIPE investors that participated in the SPAC PIPE also have an interest here. They receive restricted securities, so they have a little bit more of a difficult time selling those securities until the resale registration statement is put up and declared effective. So the trend that we've seen in the legal nuance to this is that resale registration statements are being filed earlier and earlier, even before the closing of the merger, and are being prepared, prepped, and ready to go, effective immediately following the merger. So the SPAC PIPE investors gain liquidity that much faster. This is obviously a big concern for them, but something that all should be aware of, because the faster that they have access to liquidity, the larger you'll have of freely tradable shares in the market. So with that said, I'll hand back to Niren to cover other capital raising alternatives. I think you're still stuck on mute.
Thank you, Brian. I'll go through these alternatives, and then I'll hand it back to you to talk about some of the legal considerations. This page is meant to cover more typical financing alternatives that come to mind for de-SPAC companies. The first is the underwritten public offering, public equity offering. It's a simple solution with immediate impact on the float shares and the share turnover. However, without reaching some operational or commercial milestone, a company may find it hard to persuade investors who are already familiar with the story and the investment thesis from the SPAC process. Additionally, heavy redemptions will have left the company with, as we've discussed, lower float, lower share liquidity, and those metrics are used to size public equity offerings. So this too has a negative impact on the company's ability to use this option. In the next column, the private placement can be more flexible and potentially more discreet than an underwritten offering. However, it still requires a company to build an institutional book of demand. And at the end of the day, private placement investors want liquidity at some point too. And so they'll be looking at many of the same metrics as we covered in the first column as a conceptual starting point. Finally, we have direct lending, which could be an attractive option because it's not an equity concept specifically, and it may not have direct stock price impact. Practically though, many SPACs are earlier stage companies, and they don't have the same free cash flow metrics and hard assets that direct lenders are looking for. With that, let me hand it back to Brian to talk about some of the legal considerations with the first two alternatives, as well as the equity line of credit that I'll cover on the next page.
Sure. So former SPACs, the de-SPAC company very often looks to conduct a follow-on offering as soon as within the 12-month period following the de-SPAC process. A few legal considerations here to note on the slide. The confidential filing of a registration statement has become extremely popular and widely used ever since it was introduced by the Jobs Act a decade ago. But it's worth noting that the 1 year accommodation that extends beyond the IPO very well may not be available, likely won't be available to the deSPAC company, because that 1 year, 12-month period ties to the SPAC's IPO, not to the business combination. So very likely the deSPAC company will be in a position of having to publicly file any registration statements that it's going to put up, as opposed to being able to take advantage of confidential submissions, as most operating companies can do within the 1 year period post-IPO. Additionally, perhaps even more importantly, is because of the inability to get S3 eligibility and rely on essentially that SPAC's public filing history, the deSPAC company is going to have to register any public securities offering on Form S1. This is a long form, and certain information can certainly be incorporated by reference, and the accommodations are a little easier than they had been historically, but it's not as conducive to conducting an offering as it would be off of Form S3 if that were made available to the deSPAC company. So that S1 will need to be filed with the staff publicly and then reviewed. Because the staff reviewed the proxy S4 as part of that process, it's unlikely that a newly deSPAC company will get significant comments, I think, from the staff, given the recent review that the SEC staff just did. But nonetheless, there is a process there of filing and a review, and the staff will have to declare that effective, as opposed to the normal S3 process, which is a shelf, and the follow-on offering can just be conducted by the company, by the issuer, without staff involvement. So again,
Brian, just to interject there, just a quick comment. What I would say is that it's also important to understand that in an underwritten offering, or even in a private placement, the first time out for a company that has deSPAC'd, the underwriters, or in the case of an underwritten offering or a placement agent, are going to want to leave more time to due diligence, because it will be the first time that the deSPAC'd company will be approaching the capital markets. And as we all know, in the context of the proxy prospectus preparation and the whole business combination process, while there's certainly a lot of diligence that both the sponsor does and a lot of work that goes into preparing the targets, risk factors, and the target disclosures in the S4, it's still very different in sort of character and nature than preparing an S1 for the first time for target. And I think that a lot of underwriters and underwriters counsel will want to sort of think very carefully about that. So I think a lot of time, more time, will go into sort of the first underwritten offering or the first private placement, whereas we'll talk about with Raj and Anna later, the first convert post deSPAC. So not so much a legal issue per se, as just sort of a timing preparation issue, and of course a legal issue in the sense of liability. Sorry, go ahead, Brian.
no, I think let's skip ahead to the next couple slides. I think the next point was really on private placements, or I guess back a couple slides. I think we're on private placements, but yes, there you go. Next slide. So instead of a public offering, obviously the deSPAC company can do a private, but now needs to take into consideration the exchange requirements. The New York Stock Exchange, NASDAQ, have limitations on the size of a private placement that not just deSPAC, but any company could do. And so the company needs to ensure that it's not issuing more than 20% of its outstanding common stock on a pre-transaction basis. That includes, for convertible securities, the underlying common stock that could be issuable upon exercise of a warrant or conversion of a preferred instrument. There are also shareholder approval rules in connection with any transaction that would be considered a change of control transaction or issuances to affiliates of the deSPAC company. These issues do arise, and there are a variety of ways to structure an offering to make sure that the issuer is in compliance with those rules, including limitations on an ability to exercise or convert in excess of that 20% limitation, but should be mindful of that if the private placement alternative is pursued. So with that, Niren, I'll pass it back to you.
So these are the other alternatives that deSPAC companies can consider. As I mentioned, this is the high redemption rates are a relatively recent phenomenon, and SPAC companies are still trying to navigate the after effects. The first option is the equity line of credit, which has recently come into vogue. I think since Nikola did one with Tumim Stone in June of last year, there have been 10 other SPAC companies that have entered into these agreements. These are essentially ATMs for S1 issuers. The benefit here is that the shares immediately there's lower execution risk, and the shares immediately hit the share count and increase turnover. Sort of the drawbacks are that proceeds are limited in terms of the market windows that an issuer can avail themselves of, and the percentage of daily volume. So similar to an S3 ATM. This option is unlikely to fill a large funding gap. To the next option, that's sort of long-term capital from strategic wealth, from sovereign wealth, from strategic investors, industry partners, and from private equity. No doubt, sought after capital, and there are benefits that extend sort of well beyond the actual financing itself. But in the several discussions that we've been privy to, the terms that strategics offer reflect the scarcity of this capital and the pricing power that they have. And then finally, maybe the most controversially, we have capital support from the large current and perhaps previous shareholders, such as a PE firm that owned the business before, or maybe even the SPAC sponsor. These investors are likely to control a large part of the cap table, and therefore they have the most skin in the game. So an investment for them is a very strong signal. The flip side is that many of these investors, such as the previous PE firm owner, explored the SPAC transaction as a way to get liquidity, not an incremental investment opportunity. So with that, I'd love to pass it on to Brian.
Why don't we move on to the discussion of converts? And I think Raj and Anna, why don't we pass it off to you?
Sure. Well, the purpose of this presentation is to give you an overview of the current market for former SPACs. We did want to spend just a few minutes on the overall structure, and at the very least give you the slides so you have them as reference materials. This is a traditional way in which people learn about convertibles. It is fundamentally a combination of a bond and an equity option. But this is an academic way of looking at a convert and may not be super helpful. We think it is more helpful to break it down into the cash and share flows and focus on what happens at every step of the transaction. And that will be on the next page. When we talk to issuers about convertibles, we start by breaking down what happens at the initial, interim, and final phases of the transaction. If you spend a few minutes on this page, you can understand the fundamentals of the instruments, how the premium works, how the payments work, and the choices you may have at maturity. I want to highlight that this is a simplified version of a convertible flows. When we work with clients, we think through all of the life cycle events that can occur during the interim period, especially things like change of control or refinancing. Next page, please. Before we get into the details of convertible technicals, we wanted to highlight some of the major pros and cons of the convertible to both issuers and, of course, investors. For issuers, let's compare the structure versus equity and debt. Comparing to equity, a convertible is often sold under Rule 144A, which simplifies and shortens the process, particularly for former SPACs, as we have discussed. Dilution in a convertible can be materially lower than equity also, by nature of the product and given ability to buy a call spread hedge, as well as ability to settle a portion of the convertible in cash. On the negative side, a convertible is leverage on your balance sheet. It will be viewed as 100% debt by your creditors, as well as rating agency, and you will have to repay it or refinance it at some point. Comparing to debt, on the other hand, a convertible provides significant flexibility, no restrictive covenants, no need for ratings, much quicker process. Ratings are generally backwards looking and heavily EBITDA dependent. So a lot of newer companies may not have the access to the debt markets. Much lower interest expense, of course, also because of the embedded option. Also, an ability for underwriters to pick up research coverage. This is something that Brian focused on and how important it is for former SPACs. We work with issuers on questions around syndicate structure for these types of questions. However, compared to debt, convertibles can be dilutive. In particular, even after a call spread and net share settlement, if you think your stock will grow 4 to 5 times in the next 5 years, convertibles will be quite expensive. Lastly, a portion of the convertible offering goes to hedge funds who short shares to hedge their positions. We spend a lot of time with our clients on this topic, on why people short shares and why that creates a stock impact, and of course, how to mitigate it. We recommend clients to be very focused on this point when considering convertible. While convertibles are attractive for issuers, they are also attractive for investors. Convertible indexes have done very well over the past few years, and investing in convertibles has been advantageous to the investors. The biggest appeal for long-only investors is the downside protection while having exposure to the upside. Among the major asset classes, it actually has the highest Sharpe ratio or risk-justified returns. For hedge funds, an appeal is to be able to monetize on the equity volatility. Next slide, please. Since nearly 60% of convertibles include a call spread, we wanted to spend just a minute on this structure. Investors want real exposure to the equity and a low premium, even if it means a lower coupon, while issuers often want the conversion premium to be as high as possible, even if it means a slightly higher coupon. If there's a problem and banks can make money by solving it, they will do so. That's where the call spread comes in. To bridge the gaps, banks sell an insurance policy to increase the effective conversion premium. You sign a contract alongside the convertible offering, and the banks promise to make you whole for the dilution up to a certain point. While outside the scope of this seminar, there are a number of nuances in the call spread structure, and you have to be really diligent and focus on the documentation in order to de-risk this transaction. We can spend a full hour on that, but we won't, so we will move on to the next page. We wanted to share a graph that most management teams use to understand the long-term cost of various options. If you have access to debt market, you would generally add a flat debt line across the page. As you can see, below a certain stock price, equity is the cheapest alternative. However, depending on the company's view as to the growth, convertibles become more attractive. If you are curious about the math of how we derived this chart, we're happy to email you the model. Next page, please. We did want to highlight one successful deal we worked on last year, one of the many successful deals we worked on last year, but we wanted to highlight this one in particular. Beauty Health closed their SPAC merger in early May, and seeing the strength of the convertible market, they issued a convertible in September to raise $750 million. We worked with the client to structure the deal, select the underwriting banks, and negotiate fees and economics, cap call bids, and basically the overall deal process. The deal was really well received and was upsized from $450 launch size and priced better than the best end of the initial price talks. After the deal, we also guided the company through the warrant redemption process, and we continue to work with them on the investor relations and public relations front. With that, I'll turn it to Raj to talk about the details of the market.
Melissa, next page, please. Thank you, Anna. In the next few slides, we will talk about the current status of the convertible market, and then we'll share some deSPAC specific market views. So let's start with 2021, which was a pivotal year for the public convertible market. The issuance volume last year was 94 billion, which was the second highest since the credit crisis. More importantly, we saw excitement around the asset class from high quality investors. Today, more than half of the investors in our market are long-only funds compared to only about 1/4 before. Last year was also by far the best year for convertible terms. Average coupon was 0.6% and average conversion premium was 43%, which is incredibly cheap cost of capital. Lastly, call spreads have continued to be widely used, and the emergence of advisors like ourselves means that issuers are getting better structure and better pricing. Melissa, next page, please. So what about this year, given all the market volatility? Just like other markets, convertible investors have had a choppy year so far, particularly given high growth stocks make up a significant part of our market. Year to date, the convertible index is down 7%, but the Russell 2000 is down 10%, so the convertible asset class still has done its job and provided some downside protection. Based on our conversations with investors, they're looking at this market as an opportunity to build positions at attractive entry points, so the market remains open and stable. You can see this from the deals that priced this year. Average coupon this year is 0.8% and average premium is 39%. Not as good as last year's terms, but still very, very good. So where do we see 2022 to shake out? We expect this year's market to be a market of windows. There will be choppy periods followed by periods of stability where issuers rush to the market. This may then cause deal oversupply and again, market weakness. We think terms will be worse than last year's terms, but still quite attractive. However, for companies with challenging stock technicals, investors will try to extract value. We recommend clients to be proactive and prepare ahead of time so that you can move quickly when the time is right. Next page, please. As for deSPAC converts, we have seen 18 deals in the public market, totaling about 12 billion since 2021. We have done more of these converts than any other advisors, and so a few points we wanted to highlight. A number of these issuers access the market within 4 or 5 months of the deSPAC close. However, the gating item for these companies was less the time since deSPAC and more stock borrow availability. And we'll talk more about this in a minute. More than 70% of the issuers redeemed their warrants before executing a convertible, which helped them with their borrow availability. Also, 2 in 3 issuers executed a call spread to increase the effective conversion premium. We believe convertible issuance by former SPACs will continue to be high, and we show our thought process on the next page. Many former SPACs are high growth early stage companies with significant capital needs. So we looked at technology IPOs over the last 5-6 years, many of which have similar characteristics to see how deSPACs might raise capital going forward. A sizable portion of the newly listed tech companies raised convertibles in the raised capital in the convertible market. Also, if you look at the graph, for stock prices below IPO price, that's the 0% horizontal line, more companies tend to issue converts versus equity. We believe both of these will be relevant for a number of SPACs. So our view is that as long as the convertible market remains stable, there will be significant issuance by former SPACs in our market this year and beyond. So what size convertible can you issue? For that, we go to the next page. The most critical convertible sizing thresholds are based on stock technicals. Your deal size should be the lowest of these 3 metrics. No more than 20% of your market cap, no more than 25 times your stock ADTV, no more than 2 times your stock borrow. These are not hard and fast rules. I've done deals that are 35% of market cap or 40 times average daily trading volume. But generally, these are good rules to follow around convertible sizing and protecting your stock. Of these metrics, borrow is a topic that we'll hear again and again if you are considering the convertible market, and borrow often tends to be a limiting factor for former SPACs. Melissa, next page, please. So borrow is the number of shares that are available in the Wall Street lending pool to be borrowed, often for the purposes of selling them in the market and thus effectuating a short position. Borrow comes from your long-term passive investors, so index funds, mutual funds, etc. And they put their shares to borrow agents, prime brokerages, custodians, and these agents then lend out the shares to hedge funds who take them and sell them in the market. The hedge funds pay a small fee, often 0.2, 0.3% per year, and this allows the passive investors to marginally increase their total return. So the supply side of borrow comes from long-term investors, and the demand side of borrow comes from hedge funds who short the stock. Given that many former SPACs go through a shareholder evolution phase after the SPAC merger close, we've seen that they may not have enough borrow. And we show that on the next page. So to ascertain whether SPACs really have limited, or deSPACs really have limited borrow, we looked at all deSPACs and IPOs since 2020 with a current market cap of $500 million to $10 billion. On our graph, the vertical axis shows borrow as a percentage of float. And on the horizontal axis, we show time since deSPAC or IPO. So for example, on the left side, if you see an orange dot around the 24-month period, it shows the current borrow of a company as a percentage of float where the company publicly listed 2 years ago. The data show what we already knew anecdotally, that deSPACs have a smaller borrow compared to IPOs. In fact, if you run regression analysis, you will see that even after a year after public listing, these SPACs have less than half the borrow that IPOs have. Also, while we do not show the analysis here, we have also looked at short interest trends for both data sets, and these SPACs actually do not have high short interest in IPOs. So the issue is really on the supply side of borrow and not on the demand side of borrow. So there are a few things that can naturally improve borrow. PIPE shares getting registered and PIPE investors selling out their shares to more long-term investors, cleaning up SPAC warrants, getting added to indices, and of course, continuing to execute on your business plans and continuing to build a great shareholder base. However, what if you'd like to access the markets now before your borrow improves? We discussed that on the next page. So there are a few ways to generate borrow synthetically, or at least alleviate investor concerns around borrow. We highlight the 4 paths that are actionable for deSPACs. We start with the most complicated one in the top left, repurchasing shares via a prepaid forward contract. Hedge fund short position can be created with actual borrowed shares or through a synthetic contract. So if you, the issuer, repurchase shares, you can provide hedge funds with borrow. In this case, investors will sign a contract that they are synthetically selling shares to you and will deliver actual shares at maturity. The lead bank sits between you and the investor, so you won't have to sign contracts with 10 different hedge funds. This strategy is quite efficient and can be used even if you have very limited borrow. Now, a few negatives to consider. For an efficient deal, you have to purchase about 35 cents of shares per $1 of convertible raised. So this strategy significantly reduces the amount of proceeds raised. Also, while share repurchase can send a strong signal and is common for convertible issuers, the signaling might be a bit confusing, particularly for early stage or negative cash flow companies. So there is need for investor education. Lastly, while tried and tested in the market, this structure has not been used by deSPACs yet, although the good news is we're working with an issuer right now on this structure. Number 2, concurrent equity offering. The idea here is simple. You issue common equity alongside a convertible, and this common equity can be primary or secondary. The equity deal gives investors comfort that float and borrow will improve in the future. On the negative side, though, a concurrent offering can have significant stock price impact. Also, the convertible prices off of the equity price. So if there is a discount to last trade in the equity offering, that will be reflected in the convert also. Number 3, capped call with longer dated total return swaps. When an issuer purchases a call spread or a capped call, banks hedge themselves by purchasing shares from hedge funds. You can ask the banks to execute this share purchase or this share purchase through a long-dated total return swap contract with the hedge funds. In this case, the hedge funds will synthetically short shares to the banks who need to buy shares against their call spread position. The strategy works well if you already have some borrow and you just need some incremental shares to top up your existing borrow. Also, if the maturity of the capped call TRS, total return swap, is too long, it impacts your capped call pricing. So you have to balance that against the need for borrow. Lastly, you can completely ignore the need for borrow and just sell a deal to a group of investors who do not sell shares short. This has gotten quite popular recently. Kazoo just recently issued a $630 million convertible to a group of investors led by Viking Global. The terms are pretty attractive: 2% coupon, 20% premium. Oscar Health, which is not a deSPAC, raised $310 million from Dragoneer and a few other firms at 7.25% coupon and a 38% premium. I will tell you that these deals are easier said than done. The process around these capital raises are much longer than a 144A convert process, and there is significant variability on terms, maturity, structuring, even bank fees. For most of the major strategic investors and long-only funds, the key precondition to participating in a private convertible is to find the equity story attractive. Convertible is simply a vehicle to structure the deal. On the other hand, for financial players, the structure itself is critical. This is their way to receive equity upside with downside protection. So some investors may ask for a secured deal or other provisions to further increase this downside protection. Well, the terms for private converts can be worse than terms for a regular way 144 or public convertible. We should consider that you're pricing a deal off of the unimpacted stock price. So the effective conversion price can be much higher versus what is available in the public market. Furthermore, depending on the investors, you may get a halo effect from the private transaction, and your stock may not go down or maybe even go up upon a deal. As you can imagine, these are complex strategies, and we can spend an hour on each of these strategies. So if you have questions, please ask us after the presentation or reach out to us. Melissa, next page, please. This is a general timeline for a 144A convertible. For purely private convertibles that we just discussed, the process will be 2 to 4 weeks longer. As you can see, the actual execution phase of a 144A deal is fairly quick, around 2-3 weeks. However, we highly recommend our clients to think through the structuring, considerations, process items ahead of time. I advised a company called Enphase Energy last year on its $1.2 billion convertible deal, and that deal just won the 2021 Deal of the Year award for its phenomenal execution. Enphase is a great company, but one of the key reasons that it got such great execution was that the management team was unbelievably proactive. They started thinking about the process ahead of time. And so when the time came to capture strong market conditions, they were fully prepared and were able to turn on a dime. We think getting ready early is one of the absolute best practices for a convertible offering, and we work with clients to educate them on every single aspect of a transaction: sizing and pricing, optimizing execution, change of control, investor messaging, bank structure and fees, so on and so forth. If you have these conversations ahead of time, you can significantly shorten the preparation window. As I mentioned before, we believe this is going to be a market of windows. So we really think having these type of conversations ahead of time will be particularly beneficial this year. Anna, back to you.
Yeah, Raj, just before we leave this, this timeline, you had mentioned that the timeline for a private convert is maybe 2 weeks longer. I would venture to say, just on our experience, it may even be a little bit longer than that, just to just to set expectations, because in going back and forth on term sheets and such, we're finding that the timelines may be a little elongated. And just again, to flag for our listeners, in a 144A convert with the anti-dilutive strategies that you and Anna discussed, with a 144A, you do have the Reg M exemption. With the private convert, this is structured as a 4A2. You don't have the exemption from Reg M, so it does require sort of thinking through some of the issues. But again, if you have a holder that is not going to hedge along the lines, Raj, that you talked about, then maybe some of those concerns are alleviated, but it certainly is something to talk about. We talk about some of the issues that we referenced earlier. As Brian had alluded to, most SPACs will be emerging growth companies, and they'll remain emerging growth companies for quite some time. However, they will also, unfortunately, be ineligible issuers, and generally they'll be ineligible issuers for a period of 3 years following completion of the deSPAC, so following completion, the filing of the Super 8K. And that's important to remember because it affects every single one of the transactions that we have talked about today. It affects all of the options that we discussed. It affects the ability to do a roadshow, anything other than a live roadshow, as well as the communication alternatives, the ability or inability, I should say, to do a free writing prospectus, as well as the inability to rely on Rule 144 until the 1-year period has elapsed, and the inability to rely on a Form S3 for a longer period than would otherwise be the case. So all of those are important points to remember as you factor in all of the thinking about the options that the ICR team and that we went through today. I think another topic that we didn't talk about, but that I know that the ICR team spends a lot of time on, is just doing non-deal roadshows and having opportunities to introduce management teams to investors and potential investors. And I think, we can't emphasize enough how important that has been for companies and for clients that have gone through the deSPAC process, because all of that is essential, just as the capital raising is essential. So we'll leave you with those thoughts, and we'll be sending around the materials, as I mentioned, along with the information for our next CLE in the final CLE in our SPAC series on litigation and enforcement, where we'll be joined by Stanford professor Mike Klausner. Mike has written quite a bit on SPACs, so we're looking forward to hearing his comments. I want to thank again Raj, Anna, and Niren for their comments and the materials and the data, which is really wonderful. Thanks so much for all your insights. We really appreciated having you today. And thanks to all of you who joined. Appreciate your joining and spending time with us. So that brings us to the end of our time together.
Thank you, Anna, and thank you, the rest of the team. And any of the questions we haven't answered, reach out to us. We're happy to have a call and give you the answer one-off.
Great. Thanks so much. Have a good day.